Sam and Tammy, the floor is yours.
Thank you so much. It's great to see everyone this afternoon. I'm delighted to introduce my friend and colleague, Tammy Jones. Tammy is the CEO and co-founder of Basis Investment Group, which is a multi-strategy investment and lending platform, one of the most prominent in the commercial real estate business in the United States, with a particular focus, I should say, on the multifamily sector. So part of our dialogue is going to be not only about what's happening in commercial real estate broadly, but a little bit about what's happening in the multifamily sector, what's happening with housing affordability, some of how we're thinking about the increases in insurance premia impacting housing affordability in the United States. Apart from serving as CEO and chair and co-founder of Basis, Tammy is also chairman of the board of Veris, formerly known as Matt Cali, a publicly traded firm based out of New Jersey with a significant exposure both to the multifamily sector as well as to office. She also serves on the board of directors and is an independent director of Crown Castle. If you've not heard of Crown Castle or seen their ticker symbol, what I can assure you of is that your cell phone and your home internet connection would not work without them. They own about 40,000 cell phone towers or data towers across the United States and 80,000 miles of fiber. They essentially ensure that all of our data every day gets to where it needs to go. And part of the evolution that we've seen in the commercial real estate industry, or what we think of now more as real assets than real estate, is to broaden the scope of our definitions to include assets such as data centers, cell phone towers, and other things, other types of properties and assets that don't necessarily serve in their primary function to bring people together in a way that they are physically co-located. Tammy is also the chair of the Real Estate Executive Council, which is how we first met. The Real Estate Executive Council is the world's preeminent organization of Black and brown executives in the real estate industry. It convenes an important policy dialogue in Washington, as well as in other parts of the world. As I mentioned, Basis is a multi-strategy investment and lending platform that becomes important for our dialogue today because of the role that Basis plays in helping to address the gaps in the capital stack that have emerged during it's fair to say, an unexpectedly dynamic time, for our industry. Listening in briefly on some of the questions related to the role of Fannie Mae and Freddie Mac in the industry. Basis is a licensed seller servicer for Freddie Mac. And is also a DUS partner for Fannie Mae. So in the role that Fannie Mae and Freddie Mac have in facilitating multifamily finance in the United States, Tammy and her team are amongst their most trusted and most valued partners. Tammy, just so that we can get a sense to kick us off of the significant role that Basis plays in helping to address the liquidity needs of the real estate sector, can you tell us a little bit about the platform?
Sure. Well, first of all, thank you for having me. Can you guys hear me okay? I've learned a lot. I love the presentations and the papers, and I'm always excited to talk with my friend, and hopefully you guys will learn some stuff. So you gave a great bio, but I want you to think about Basis as 3 legs of a stool, really simple. We have a credit platform, so we are providing commercial real estate alternative credit. If you think about the commercial real estate market, debt market, there's 4.6 trillion of debt that's outstanding right now. Most of that is the banks at like 38%. Then it's the insurance companies. Then you have the GSEs, actually it's the GSEs, Freddie and Fannie, then the insurance companies, then CMBS. And then you have this 10% of the pie, which is alternative lenders, and Basis falls in there. And so credit platform's the first leg of the stool. Then I have, as Sam said, I'm a licensed Freddie Mac, or the firm is a licensed Freddie Mac and Fannie Mae lender, which means that we are providing liquidity vis-a-vis mortgages that are sold. We talked about how the risk is transferred, that are sold vis-a-vis mortgage-backed securities for Freddie and Fannie. The loans don't typically stay on their books. The seller services originate the loans, and then they move them into the capital markets. And then we actually invest as commercial real estate equity owners and partners. And Basis manages public pension fund capital for some of the largest public pension plans in the United States, sovereigns and family offices. So we're taking the capital of, for example, New York City pension fund, teachers, firemen, civil service workers, and part of their public pension dollars goes into alternatives, which is, and real estate sits there. So we see a lot because we have these three platforms. So we have you know, just an idea of what's happening in the capital markets on the credit side, what's happening in the agency world, as well as in commercial real estate equity.
So I mean, a lot of the dialogue in the business sections of the newspapers, on CNBC on any given day, is focused on some of the challenges that we face in commercial real estate as an industry. And from my perspective, it's really a combination of two things. One, a radical rethinking in some cases around our relationship to the built environment. How do we think about the way we use our spaces? But it coincides with a dramatic increase in the cost of financing for an industry that ultimately is heavily dependent upon the availability of debt. Directionally, as compared to 6 months ago, where are we in terms of real estate capital markets? Are things improving? Are you seeing green shoots? Is financing more readily available, or are we still in sort of the tight spot that we've been in for a little while?
So it's a great question. I would say that today, as we sit, I feel like it's better than 6 months ago, but it's so volatile that next week it could go back the other way. There is not capitulation between buyers and sellers in the commercial real estate market that we would like to see to create an environment for transactions to happen. And the reason for that is because the financing is so high, and loans, properties are, if you buy a property today, you may be in negative leverage because we haven't hit that point where interest rates have, been decreased enough to facilitate transactions volume. So there's a lot of capital on the sidelines, though, which I really believe is important, because last year, by way of example, the agency volume, Freddie and Fannie's volume, was down, 50% from the prior year. And that's a significant indicator of just not a lot of transactions happening. But I will say, just as where the rubber meets the road, we talked about, our pipelines of debt and equity are actually starting to increase. Doesn't mean that we're going to get all these transactions done, but there's just more activity. People are starting to tip their toe in, which is always a good sign. But what has to happen is, interest rates, unfortunately, need to come down. Cap rates, which is, obviously interest rates are part of your weighted average cost of capital. Cap rates need to come down. And so until that happens, acquisitions, we see some large deals happening with some of the large players, but in the smaller market, the middle market, transaction volume is still down.
Sure. When we are thinking about interest rates, obviously, the market is, immediately focused on sort of what the Fed's next move will be with the Fed funds target rate. When you look at what's happening in the real estate industry, some of the public and policy dialogue is focused at the other extreme on what's happening with the 30-year mortgage in the residential market. Somewhere in between, on the yield curve, we've got financing for commercial real estate, due to the terms, the durations. Has the cost of financing started to come in a little bit?
It has. Like I would say CMBS spreads, which is another indicator, have come in a little bit. We're still, if you think about rates right now, if you're doing in a commercial real estate transaction where you buy a multifamily property and you want to renovate it, and say it's $100 million investment, you are still paying 8 to 9% for a first mortgage. Compare that to when money was much cheaper. You could have a 4%, 5% mortgage for whatever, 3 years, 5 years, whatever the duration is. So it's very expensive.
Sure. And for folks that may not be intimately involved in the commercial real estate market, a key difference for us as compared to residential is that we don't have 30-year terms. No. The amortization periods may be somewhere between 25 and 30 years, but terms are anywhere between 2 and 10 at most.
2 and 10.
So everyone's got to reset, and roll over fairly large, balance into new financing at a much higher rate.
Right, and that's the problem, because right now I think one of the most significant things that we all face is there's about 2.6 trillion of debt that's maturing between now and 2026, and many of those investments or loans are not going to take out if interest rates stay the same, because unless there's an equity infusion. And so that's a significant risk that we're all watching as commercial real estate owners, investors, myself on the lending side. And it really is something that it's, when this happened in the great financial crisis, the banks were able to kick the can and extend and pretend. Remember that stuff? Well, this time it's much more significant in my view, because the valuation impacts are much higher, because we're facing all these other risks that include, like we talked about, insurance costs, which I want to go into a little bit, extreme weather, that relates to insurance costs. We're looking at a transformation of office. I mean, you all know that in COVID, office just, kind of went away for a moment. It has not come back. And that affects our cities and tax revenue and businesses. And so there is such, a multiplier effect in some of the things that we're seeing. And we've lived through this before, because remember when with e-commerce, we had retail that all of a sudden transformed. And so now I believe retail has right-sized. I have a good retail story that Sam will, that I hope relates to the volatility and climate change that I'll talk about. But I was just going to say that we've seen a reset of a massive sector of commercial real estate called retail as a result of technology. We have COVID, and now we have office and the way we work has changed. And we have all of this office inventory across the nation. And that's one of the most significant risks that we're looking at. Lots of those properties are insured by folks. Valuations have come down by 40%. And so we have a problem as a nation across each of these major cities in particular to figure out, what do we do with all this office? And all of this office, I'm here to tell you, cannot be converted to multifamily, which would be a nice, easy solution. So that is one of the most, I guess, to me, distressing problems that we have as an industry, is trying to figure out how we hit the reset button. And I think there are solutions that we can talk about.
Yeah, so, office has been sort of the focus of so much of our conversation as an industry over the course of the last couple of years, because that's sort of the immediate threat in terms of what we do with our debt, what happens to the valuations of the assets. But to your point, whether or not and how often people are going into work, has bigger implications for the economic and social geography of our cities. It has implications for where we decide to live, whether or not we're getting on the subway every day, the kinds of tax revenues that we generate within the boundaries of the urban core. Tell us briefly a little bit about what you see happening in some of the other property types. You mentioned that sort of your retail, it's taken almost 20 years, but retail's kind of sort of, supply and demand come back in some reasonable balance. Are you seeing signs of material weakness in multifamily and industrial that we should also be thinking about those sectors?
So it's a great question. So retail definitely has, I'm just surprised at how it's recovered compared to where we were even pre-COVID. And I think that when you step back, we can learn some things by looking not just in our own national United States, but looking more broadly. And the United States had many more malls and retail properties than any other place in the world. And so we have been right-sized a lot, some of the closings of malls. And we remember every time you turned around, some other mall was closing. So I believe that helped part of it. And then I think that the way that retailers did business also transformed to use more technology and online stuff. And we adapted. And so that's sort of the, socioeconomic behavioral things that adapted. So that sector's doing okay. Multifamily, there is an affordability crisis in housing in the United States. We all know that we do not have enough places for our citizens to live. And so as a result of this interest rate, 500 basis point increase over the last year and a half or whatever it is, we've seen construction start to slow down a lot. And so that's going to hopefully help multifamily when it recovers at some point. But right now, multifamily is the darling of all of our property types. However, there are headwinds on rental growth across the nation. And there's been a migration, as you pointed out, for folks, because they're coming into the office not 5 days a week, being able to live in the suburbs or live in other places where the tax base is cheaper and the quality of life is better. And so I know that, I grew up in New York City in affordable housing. I'm a New York City girl. I love New York, but I do think that we have some problems here because of how expensive it is to be here, and to make sure that we can attract people. I think that you and I, we had this conversation on another panel at ULI. We have to figure out how to keep people here by addressing some of these issues that we've talked about.
Sure, the issues around sort of tax efficiency and the competitiveness of our cities across a whole range of dimensions, whether it's sort of the tax issues, the quality of infrastructure, our ability to sort of meet the housing needs of a broad cross section of people, are all things where, again, all of us believe in New York City, but we clearly have some work to do, whether it's New York, Chicago, Philadelphia, Boston.
And I would just add, so we're seeing rent growth stronger in some of the middle market cities, what I call, the smile areas, some of the coastal markets. We're seeing more rent growth, multifamily rent growth versus places in the major metros because of what's happening with office and people moving out. Industrial is still doing okay. I mean, data centers we talked about, towers, I like to call them, they're real estate without walls and antennas for tenants. And so it's Verizon and, AT&T and T-Mobile. Those are that sector. I would say, student housing is doing well as universities continue to thrive. We also invest in hotels, limited service hotels are actually doing well. So there are some bright spots in the commercial property world. However, what we're most concerned about are the maturities and also the ability to, acquire and have transactions volume get back to what it was, given that the math just doesn't work based on where folks have their return hurdles and how much the debt costs. And so it literally is just math.
So I do want to ask you about this maturity. So at the Volatility Institute in our finance department here at Stern, we've got a lot of folks that are thinking about issues related to financial stability. When you're thinking about those $2.6 trillion in maturities over the next couple of years, do you see that, do folks in the industry see that as a potential threat to financial stability through the channel of failing banks? Or is this something where, in some of the smaller markets where that regional or community bank may be the only source of financing, that those are disproportionately impacted by lenders stepping back?
It's a great point. And if you talk to any bank, and obviously basis, we have lines at different banks. If we talk to any of our relationship lenders, and we deal with all the major ones and some smaller ones, and I won't name names, but everyone is pulling back. We saw what happened with Silicon Valley Bank, with Signature Bank. The commercial real estate portfolios they're in heavy asset management mode. There's a question mark about valuations. Although these property types have not plummeted and they're not, there is, as I said, bright spots, there's still valuation concerns because of the instability with interest rates and with cap rates, which drive how we look at what something is worth. And because transactions haven't traded, there really are no comps. And so what we typically rely on is, okay, something is worth that because 3 properties just sold and that's what it is. And here's the income. And so we don't have a lot of that data. So the banks are pulling back, which creates opportunities for alternative platforms like Basis. But as I bring you back to my pie chart, those alternative sources are only 10% of
the capacity isn't there to fill the gap.
It's not there. It's like when I hear people say, we're going to stand in the gap for the banks. I'm like, really? Because you have a little 10% slither. So I do feel like the banks, if they're in risk-off environment and they pull back from commercial real estate lending, which many of them are doing, then it will have impacts, particularly in smaller markets where there is, if the community bank is the only source, that is going to be a concern. As it relates to working through the portfolios, it just really depends on how the economy does, whether we can get, if it's going to be higher for longer, how much longer. I asked whoever's in the Fed here to help us know that, because we just don't know. And every time we look at the forward yield curve, I feel like it changes, and we feel like we're closer, and then we're not. And then, today I'm reading about stagflation, and looking at just all the different forces that come into play. And we haven't talked about one of the biggest threats to commercial real estate is when we think about ESG. We are a real asset. We are a tangible asset. We have real threats and risks that people are ignoring. Folks are not underwriting, in my view, for insurance costs. I mean, we used to underwrite 3% for like years and years, 3% increase or 5% increase. And I have a couple of investments in my portfolio in Florida where it went up by 25%, 30%. And so that impacts returns, that impacts costs go up, then the owners of the property, like us, you know, and some of our partners, we didn't anticipate that we need that capital. And so there's, again, I want you guys to think about the multiplier effect of all of this that's happening. And so we look at corporate level risk if we're going to invest in back an owner of real estate. We look at the corporate level risk, and we look at the property level risk to see, you know, are there climate issues that we should be taking into account and trying to figure out how we can underwrite for those risks the best that we can. And we have a proprietary system. When I go to my investors and I talk about it, I get the sense that not everyone does that. And for me, it's where we have seen the biggest losses, particularly when you ignore whether it's infrastructure that's deteriorating. Obviously, as real estate folks, we're focused on that. But if you ignore, and you know, and I'll say on the positive, there's also tremendous savings and upside for backing sponsors that actually care about energy use, water consumption, that are, you know, focusing on their fiber footprint. Those are really important things, and we try to give credit there as well. And we want to focus on sponsors that and folks that own property that care about that. But it definitely is a problem. The real estate industry lags, I think, other industries sometimes in getting organized about how we should look at these risks. But I think there's many folks like me and some other firms that are really pushing.
Yeah, so I know that you've invested heavily in the development of your ESG scoring, you know, criteria. In another conversation, I'll ask you, and another day I'll ask you about whether or not there's been, you know, more pushback in the last 12 months, particularly sort of, you know, knowing the knee-jerk reaction to sort of, you know, even just the acronym ESG, there have to be parts of the country where you're active where it's not as well received.
But change the name, Sam. I just call it sustainability.
Sustainability. Yeah. But I also want to ask you specifically about, you know, issues related to climate risk and your thoughts on insurance, given, you know, the thematic focus of today's program. And I know you have an anecdote for how climate risk, you know, came home to roost for you.
Yeah. So absolutely, it's a big risk and cost, and it's one of the places where our underwriting investment committee will make sure that we are stressing insurance to the best of our ability. And even when we've done that, I can tell you that sometimes we're wrong. We're wrong a lot because we just don't know where the costs are coming in. And if there's an extreme weather event or something happens, then all of a sudden the costs go up even higher. So that's one of the biggest line items for us that is very uncertain. A line item that used to not be as uncertain, you know, a few years ago. We actually invested in a mall that it was in Jonesboro, Arkansas. You guys can Google it. It's called Turtle Creek Mall. And what is it, EF3? Is that the right terminology? The tornado, I'm looking at my tornado guy. It came through, at one point it was EF5, but when it came through the mall that, of course, Basis had an investment in, it was EF3. So that's about 150-mile-hour winds. And it destroyed our collateral, like literally destroyed it. And there were, no one was seriously hurt, thank God. But I always say that was probably the best thing that happened to that mall, because the valuation was, it wasn't a mall that was performing so well. But even with that, even with the insurance, the other issue that we have is the cost of insurance and the risk. And I see this as a lender and as an investor, that folks are underinsuring, and that loan was underinsured as well. So we are going to take a loss, but it's not as big a loss as we probably would have taken, had it just continued, because the valuation was an issue as well. So these are real life examples of how you don't know when you have tangible assets where these extreme weather events are going to happen, and what the implications are. And when I step back and I look at that one little microcosm, that was a mall that was, had provided jobs and a place for the community to come. That mall has been closed for 4 years. We're still working on that. So once these things happen, they take time. There's a lot of people involved, lots of fights with insurance companies. And so that's our real life example of something that we couldn't have underwritten for, but now when we have some of the investments in the area, insurance costs have gone up a lot, and there's nothing we can do about that, because they're, now there's a more significant risk, I guess, that's underwritten by the insurance companies.
Yeah. So in a moment, we'll move to questions. One more that I have for you. Then you gave the example of Florida, where residential, both multifamily and single-family residential, your insurance premium have been rising so rapidly and unsustainably. If you're a multifamily, investor with a significant portfolio in a place like Florida or in California, how are you at a time where you may not have as much pricing power to pass along these increases, or if you're in the workforce housing space or affordable space, maybe you don't want to pass these increases along, or you can't pass the cost increases along to your renters? What do you do? This has to undermine your debt service coverage.
Well, yeah, no, it does. And it takes your returns. And when you're investing money, again, this multiplier effect, and you promise your investors, I'm going to give you, 10%, I'm making this up. And now you have a line item that's basically, and with interest rates, now you have debt services, interest payments are higher, and you have insurance costs that are higher. Then you have an asset that has cash flow that's much lower. And we value things based on cash flow, so the value has just gone down, and it can be dramatic. And so then you have do the sponsors want to give the keys back because they can't see a way out unless there's a change in interest rates and unless there's some way to deal with the insurance costs. So I believe, and I think many of my colleagues believe, that we're going to see this time a lot more properties just given back, a lot more distress this time than the great financial crisis, because there are different dynamics that are affecting where we are, and higher for longer makes this problem more exacerbated. And with, couple that with the increases in insurance expense, I can see properties that, 3 years ago, you thought they were positively cash flowing that are negatively cash flowing right now without any way out, because cap rates are still high. So there's, if an investor can't see an exit, then it's like throwing good money after bad. And so at some point, and I feel like those situations I'm seeing more and more. And, again, to make it positive, there's also opportunities to reset the basis in the property, to go and now have new owners come in. And so that is the other side of it. But I do think we're going to go through some pain.
Yeah. So I think we just have maybe 1 or 2 minutes left for a couple of questions. Sir.
Hi, Morgan Stanley. I have a question about how you see the lenders' sensitivity. I'm on the commercial real estate side, particularly on the office building. How the lenders' sensitivity around climate risk factors have changed recently. So in other words, do they, in your view, do they ask a more detailed question to try to underwrite the risk of the climate risk factor?
If they'll make an office loan at all. Yeah.
Right. If they'll make an office loan at all is right. I love that question, because I think that basis does. And it's really hard when you're a lender, because you don't own the asset. So when you're asking a potential borrower for information, and the rest of your competitors are not, it's not easy. But we do it. We absolutely do it. And we have this questionnaire that goes out, and we say, if you want our capital, then you will answer these questions. And we promise you that, this will be better than dealing with X company. And then we ask for quarterly updates to help us. It really is, I think some people are starting to ask the question, but it's really, it's not just asking the questions, it's also using the information and trying to figure out, how does this change your underwriting? Does it change your underwriting? Because just asking questions doesn't change anything, but just understanding, like for us, we rank the properties to say, is there more climate risk, for lack of a better word, here in this particular location than some other property, some other place or other property type? And that matters, because I'm managing a portfolio, and it's portfolio risk, right? And so I think that the more, I'm doing what I do, and I'm sharing it with my investors. They like it.
Doing what you're doing?
I get the sense that not many. But I do think that the more, it's like anything, you have to shine the light on it, talk about it. And once other people hear that basis is doing it, then I'm sure they'll start doing it too.
Yeah, I think we see the same. We're talking to commercial real estate risk managers at large, banks. Most, I think, will say that they're moving much faster in collecting data than they are in actually using the data for any useful decision making. Dick, how are we doing? We have time for one more question? Yeah. All right. Fantastic.
I don't know where.
Oh, go ahead.
So, all right. I think this is a quick question. You mentioned that you expect, you talked about the great financial crisis, and there's a lot of extend and pretend that kind of kept things going until the economy improved a little bit, but you expect much less of that this time around. And I'm just curious, like from the perspective of a bank or a lender, you're going to get the keys back on a property that's worth, it's already worth 40% less and probably be worth even, be worse than that by the time you get it back. Aren't there big incentives to kind of kick the can and hope that eventually the economy rolls over and the Fed does cut rates?
I think that the answer to that question lies in what we saw happen so quickly with Silicon Valley Bank and what's the other one? I just said it. I'm like Signature. Thank you, Signature. And just the stress and focus from the regulator on the books of these commercial or just these banks, and particularly the commercial real estate portfolios. My sense is that there's a write down now that's happening more rapidly from my discussions with some of the bankers than what happened in the great financial crisis. And so if you've already taken a unrealized loss and you've already marked your books, then it gives you, an ability to liquidate more heavily. And the more you keep bad debt on your books, the less you can do new debt. And so there's also the allocation issue. And so I think it's different. I mean, I think, yes, my firm probably has more time because we have a longer duration for our capital. And we're not, I'm a registered investment advisor, but we're not regulated the same way as a bank on tier 1 capital and all those things. So I do sense that there's a real stress issue. And the only way to deal with that is not to try to, continue the, hope for the best, but to actually start liquidating. And we're starting to see bank portfolios, which again, there's the distress and then there's the opportunity. So.
Friends, Tammy Jones.
Thank you very much.